Financial regulation serves to promote financial stability. The objective is to prevent things such as the Great Recession from ever happening again. Some of the key challenges facing financial regulation are, first, to reduce the probability that firms will fail, and second, to reduce the impact the failure of a firm would have on the financial markets and the economy at large. To reduce the probability of failure, policymakers and researchers are looking at ways to make banks safer. That entails improving capital regulation, improving liquidity regulation, improving risk governance, and a variety of other measures. To reduce the probability that firms will, if they do fail, adversely impact the economy, a lot of research is going on both in industry and in academia to make investors, not taxpayers, responsible for bearing the cost of bank failures. The trends in financial regulation today are to improve regulation, above all with respect to capital, liquidity, and risk governance. Secondly, to devise means to resolve failing institutions. And thirdly, to look at what's called macroprudential supervision, to look at the overall system-wide aspects of what financial firms do. The balancing act in regulation is similar to the balancing act that is in other areas of the economy. Above all, one has to strike a balance in financial regulation between risk and reward, risk at the individual bank level or at the individual firm level, and reward to shareholders, and risk to the system. And the role of public policy is to make sure that the economy and the society as a whole do not come up too short when firms make that calculation on their own behalf. Looking into resolution, that is, what happens when a bank fails. The question is, how can we do better than in 2008? How can we do better than we did in the case of RBS, when the taxpayer had to bail out the firm? How can we do better than we did in the case of Lehman's, when it went bankrupt in a very disruptive manner to the financial markets? The answer is to put in place something akin to a pre-pack insolvency procedure so that investors, not taxpayers, bear the cost of bank failure. Some of the key insights from my work on resolution are that it is feasible to allow banks to fail. One can make what I call banks safe to fail, so that taxpayers don't have to bear the cost, that investors bear the cost, and that banks can fail without adverse effects on financial markets or the economy at large. And this is being translated into policy in the form of total loss absorbing capacity requirements as decided by the Financial Stability Board just last week. The question of how well prepared we might be for the next crisis is one that is always asked. I would like to believe we are much better prepared, and that banks in particular are in much stronger shape. They have better capital, more liquidity, and they're much more soundly run. There is still some ways to go, and policymakers and banks are on the way to accomplishing that. We should not take comfort from the fact that banks are stronger. The world is an uncertain place, and banks and financial firms have to be prepared to deal with that uncertainty. Well-managed firms will make a good trade-off between risk and reward, and they'll get paid for taking the risk.